Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 273rd VideoCast podcast for the week ending January 9th, 2025. Got a lot of incredible stuff to cover this week, but as always, family first, then we'll get right down to the data. These are my three beautiful girls. Obviously, my beautiful wife, Caitlin, right in the middle. There's Mimi and Annabelle. This was at great restaurant near us called Blue Gold, overlooking the ocean, beautiful sunset before I went to New York City on Sunday. That was Saturday night, and already back, did a media thing. This is the green room at the Clayman Countdown. I always like to show behind the scenes for new listeners and viewers. That was with Taylor Riggs, who filled in for Liz Clayman because Liz Clayman was at the Consumer Electronics Show in Las Vegas. That was amazing. First time going on with Taylor. Really enjoyed that. I mean, she's phenomenal, by the way. Marathoner, law degree, CFA, new baby, new family. I mean, there's nothing this woman can't do. It was absolutely spectacular. Those are the two girls. They're enjoying the hot tub action in California. You don't get sunsets like this anywhere else. That's me and Mimi. Absolute awesome time. And then I had the privilege early this week to be in New York City, and that's with Kristen Scholler, NYSE live TV overlooking the New York Stock Exchange. It never gets old going down there. Absolutely incredible. And this is in front. It was 20-something degrees, big change from Southern California. Felt, they said, feels like 8 degrees. So I put on the snow hat and bundled up. That's the New York Stock Exchange in the background. In the lobby where you go in as a speaker and the producers come and get you, they have all these companies that have gone public. And this was really interesting. This was Stanley Black & Decker talking about the first cordless drill and some of the amazing innovations that they've had over the years, just the beginning for them. And that's the floor. So on to it. Media first. This is going to give the broad, comprehensive overview. Got to join Taylor Riggs and my buddy Kenny Polcari on Monday on the Clayman Countdown Fox Business. Thanks to Jake Mack. Brooke Haliskak produced the segment. Thanks to Catherine Myers. Obviously, thanks to Liz Clayman and Taylor Riggs. So we're going to listen in here.
Joining me now, Great Hill Capital Chairman Thomas Hayes and Slate Stone Wealth Chief Market Strategist Kenny Polcari. Great to have you both with me. Thomas, let me start with you. Just in terms of the action today, big tech, leading today, all eyes on tonight. Do you see big tech, AI, as another sort of big theme powering this rally for the rest of the year?
I think that actually Magnificent Seven will do okay, but probably not as well as last year. Last year you had much higher earnings growth. This year that earnings growth is going to decelerate for the Magnificent Seven from 33% down to 21%, and you're paying 33 times earnings. So I think the theme for 2025 could be the last shall be first, and you could start to look at some sectors that really underperformed in 2024.
Before we get to those, Kenny, you weigh in. Do you see Mag 7 as maybe not the biggest performer for 2025?
I agree with Tom. I think they're still gonna perform well. I don't think you're gonna see a repeat of what happened in 2024. But I think there's another group within tech that's really starting to raise its head, and that's the quantum computing side. There's been a lot of talk about it over the last couple of weeks. A lot of very interesting names. They're having really, really interesting action. Some of these stocks really being gobbled up because of what quantum means for the future of AI and how it's going to continue to change kind of that landscape. So while I agree with Tom that I don't think the Mag 7 is going to continue to have the great year, I'm certainly not a seller of the Mag 7 at all.
Yeah, that makes sense. Thomas, so talk to me what you mean. The last shall be first. Yeah. Explain.
Well, if you look at two sectors that dramatically underperformed, healthcare and materials were both only up low single digits in 2024. Okay. But if you look forward to 2025, they have among the highest expected earnings growth. Healthcare is going to grow earnings 20.4%. Materials is going to grow earnings 17.4%. So we think there's a lot of opportunity there, and we think it's consistent with value could start to see a bid. Those unmagnificent 493 could start to see a bid in 2025. It's the cheapest value has been relative to growth since 2000 and since 1980, which were two generational opportunities to buy value.
Kenny, do you agree with that, particularly when it comes to healthcare?
I do, because to Tom's point, those two sectors were the underperformers. Now, if they grow at the rate Tom says they're going to grow, that is the expectation. So if they grow at that rate, certainly they should be close to the outperformers of 2025. Now, that's still up in the air, right? We have to see if they're going to, how earnings is going to start and what the projections look like to verify or not those earnings growth rates. But one way or the other, to Tom's point, the last could be first. You could see some of these sectors that were the underperformers really kind of take over.
And I'm assuming in healthcare, it's not just Eli Lilly, Novo Nordisk giving me my GLP-1, right? There's got to be a better name in healthcare.
Yeah, we like XBI, which is a basket of biotech stocks. The same thing happened in Trump 1.0. As soon as he got elected, the whole basket sold off in anticipation he was going to tear up the Affordable Care Act. Right now, it's down because of RFK Jr. After the inauguration, biotech rallied in 2017 over 75% the next 12 months. We think there's huge opportunity. Why? Deregulation. FDA is going to approve more drugs. FTC is going to approve more deals. Big Pharma, record cash on their balance sheets. They need innovation. They're going to use that cash to buy biotech companies at record low valuations.
Kenny, do you agree that the RFK fear within healthcare will be sort of resolved soon, as perhaps they realize that he, I don't know, maybe is it more bark than it is bite?
No. I actually think that having RFK come on as the health czar might actually be good. We'll see a lot of things maybe remade, right? There are cereals in this country that aren't allowed in other countries because of what we put them in here in this country, and he's trying to fight against that to actually make them healthier. So I'm all for it. But yes, I do think we saw like big names in healthcare, Lilly and all that, kind of come off on that original RFK move. But I think we're going to see a bounce back in some of the biggest healthcare names.
All right. Well, I love having you both. Great to have you, Thomas, here in studio. And Kenny, always fun to see you there down in Florida, I suppose. All right. Now, just to recap, markets open.
And we're back. Then on Tuesday morning, I had the privilege to join the great Stuart Varney, and that's Lauren Simonetti. Absolutely incredible. I want to thank Preston Mizell and, of course, Christian Dagger for booking me on the show. Absolutely great. We got to talk about my favorite subject, which is NVIDIA, and Icarus came into the story. For those of you who know a little bit of Greek mythology, we'll talk about that. But we also talked about price versus value, so we're going to listen in here.
Let's bring in Thomas Hayes. You're watching our market for us. Now, are Jensen Huang's comments going to push NVIDIA to new highs?
I think so. You're familiar with the story of Icarus. The bad news is Jensen Huang is flying too close to the sun. The good news is his wings are not melting yet. And I think that the company's at $3.7 trillion. It wants to probably push to $4 trillion. That would be 8%. I think beyond then, like every semiconductor cycle, right now he has no competition. Competition is coming. And as far as training the robots and training the cars virtually, what could go wrong, right? Versus having to put the cars out on the roads, you're putting it in a studio. We'll see what happens. But on balance, this is a positive thing for NVIDIA. It probably pushes a little bit higher from
Most of the people watching this program who have any investment in the stock market have some money in the Magnificent Seven, big tech stocks. In a nutshell, give us your forecast for the Magnificent Seven in 2025.
Okay, but not quite as good as 2024. Why? Because earnings growth is decelerating. They had 33% earnings growth last year. They're going to have 21% earnings growth this year, and the multiple has not yet re-rated downward. You compare that to the broadening of the rally. Small caps are accelerating earnings growth from 8% to 21%, but you only pay 15, 16 times for that earnings growth versus the Mag 7. You're still paying 33 times. Same growth, half the multiple. Where are you putting your money, Stu?
Small caps look better.
Yeah.
I'll see about that. Tom Hayes, great stuff. Thanks for joining us. The International Longshoremen's.
And we're back. Then I had the privilege to join Kristen Scholler down at the New York Stock Exchange. This was a comprehensive 2025 outlook and two picks that we don't get a lot of opportunity to talk about. So you're really going to enjoy this one. And here we go.
As we dive into the markets, now just one full week into January, I do want to bring in Thomas Hayes. He's a chair and managing member at Grey Hill Capital. Thomas, great to have you on the show.
Great to be here, Kristen.
And as we start this new year, so much focus as to what is in store for stocks. We've seen some choppiness. The S&P just about 3%, though, from its record high. What are you watching?
Yeah, I think this year is going to be a year of slightly more subdued returns and a rotation. So it's not going to be as easy as parking the money in the indices and watching the Mag 7 take you to the promised land. I think what you're seeing is the deceleration in the earnings growth of the Magnificent Seven. So they had 33% earnings growth in 2024. That's going to decelerate down to 21% in 2025. However, you're paying 33 times earnings for it. So you haven't seen any derating in the Mag 7. And if you contrast that to small caps, their earnings growth is going from 8% in 2024 to 21% in 2025, and you only pay 16 times. So half the multiple for the same earnings growth. I think we're going to see a lot of fits and starts as the market starts to recognize where the value is.
What does that mean for the rest of the market, knowing that the Mag 7 is expensive?
Yeah, I think you're going to see huge opportunities under the surface in the unmagnificent 493. Some of the areas that got hit exceptionally hard in December, you know, we did see the broadening start in earnest in July of last year, and it really hummed along until November. And then there was this abrupt interruption as yields blew out, as fears around the Fed in December. We saw the exact same thing in Trump 1.0. Right after he got elected, the dollar rallied, yields rallied between the election and the inauguration. After the inauguration, all of that cooled down.
And because we're talking about yields and the economy, I do want to get your take, Thomas, on the ADP print that we saw today. Because yields have been such a topic of conversation in terms of the direction of this market, 122,000, a little bit less than what was actually expected by economists. What might this mean for that non-farm payrolls report on Friday?
Yeah, we keep toggling between bad news is good news is good news. I think this is a situation, given what yields have done, we do want to see a little bit cooler labor market to keep the Fed possibly in the game, number one, and to put a cap on yields. Yields have really blown out a little bit since the election, just like we saw in 2016. I think a cooler report, if the ADP is any indicator of the non-farm payrolls report on Friday, that's going to be a very good thing for the market. Yields will start to calm down and compress, and the Fed stays in the game, and equities will like that.
International has been out of favor for a long time. Does 2025 change that?
I think it's in line with the theme of what I'm talking about. Price is what you pay, value is what you get. You're going to have over 13% earnings growth in international. It's trading at 15.5 times earnings. In the U.S., you're going to get 14% earnings growth, and it's trading at 22, 23 times. So the thing that people forget, because we're all creatures of habit, recency bias, right? Since 1927, value has outperformed growth by 4.4% per year. Okay, only in the zero interest rate environment since 2010 have you seen growth dramatically outperform value. So unless you believe we're going back to zero interest rates, you want to have some lower price value in your portfolio. You don't have to shift the boat all the way right away, but start to ease into where there's value and opportunity and still growth in earnings power.
Particular stocks then, Thomas, that are on your radar?
Yeah, well, I'm known around these parts as Turnaround Tom because I like buying stocks that are down a lot, but have an opportunity to turn around. One is Advance Auto Parts. They're an auto retailer. They got absolutely decimated. They overexpanded. They brought in a new CEO, Shane O'Kelly. He came from HD Supply, was a $7 billion business. So what has he done? He's taken solvency risk off the table. He sold the Westpac Canada business, $1.5 billion, paid down debt. He's closing all the non-performing stores in the West Coast that are very spread out, so they weren't getting economies of scale. 10% of the stores. He's expanding in those regions where they're number one or number two, consolidating the distribution centers. They are targeting $630 million of operating income by 2027. The last two times they traded at that level of operating income, it was $180 to $220 stock. It's trading at $45 today. So this thing can really grow over the next couple of years under the right leadership.
I want to talk about small caps as well. We've seen optimism return, certainly with certainty following the election. Small caps have lagged behind those Magnificent Seven stocks as well. You talk about growth, we talk about value. How do small caps fit in?
Well, I think small caps is where you're seeing the most value. One of the names that we love is a company called Cooper Standard. Again, 2 auto turnarounds for you. You know, people are sleeping listening to this, but this is where the opportunity is going to be in 2025, 2026. This company's down 90%. It had a refinancing risk. They got it refinanced in 2022. They do the sealing systems around the doors, boring stuff, fluid transfer systems. The operating leverage in this business is huge. All this is a play on volumes increasing. We did 16.8 million annualized SAR in December. If you remember, those auto numbers surprised everyone. The volumes are coming back up. The last time they did 17 million, the business earned $7. It was a $140 stock. Stock's trading at $14. They've taken $400 million of costs out of the business. So this thing, we believe, over the next 2 years could earn $7 to $10 a share, which means, you know, you apply a 10 times multiple, it's really going to move.
All right, Thomas Hayes, in from the West Coast.
Yeah.
Thomas, always a pleasure. He's a chair and managing member at Great Hill Capital. Thank you.
Thanks for having me. And we're back. And from the NYSE, obviously want to thank Kristen Scholler, want to thank Melissa Montanez and Jeff Cohen for having me on there. And then finally, I had the privilege to join Mike Larson on The Money Show with Mish Schneider and from Market Gauge and Chris Preston on Cabot Network. You can go to the website and listen to the entire thing, but we've abbreviated it here just to go through some of the picks and also the framework that Turnaround Tom, that's my nickname, uses to find turnarounds. I think you'll find this extremely beneficial. Thanks again to Mike, obviously Kim Gittler over there, who owns the whole thing at The Money Show, legendary 4-decade-plus business of prominent speakers throughout the years, financial markets, absolutely incredible organization. So here we go.
I do think it's important to ask something right off the bat, and that's, you know, is this finally going to be the stock pickers market we keep talking about? You know, we've had this just buy big tech and you're fine otherwise. Tom, why don't you start with that and let me know if that is the case, why or why not?
Yeah, I think that's a great question. That's the $1 million question for this year, Mike. Thanks for having me. I think what we're seeing, though, if we're realistic and objective about what's going on in the market, what we are seeing is a deceleration in earnings growth for the Magnificent Seven, which kind of has driven the bus looking backwards. Earnings growth dropping from 33% last year to 21% this year. However, the multiple on the Magnificent Seven has not yet derated in accordance with the earnings growth deceleration. So I think they're going to perform less well. They'll do okay this year. But if you contrast that to kind of the broadening theme and take a look at the other end of the spectrum, going from large cap growth to maybe small cap value, you look at earnings growth acceleration in the small cap 600. Earnings growth is growing from 8% last year to 21% this year. The difference is for that same 21% earnings growth, whether you talk about Mag 7 or you talk about small caps, is the price you pay. And on Mag 7, you're still paying 33 times earnings for 21% earnings growth. On small cap, you're paying 15 or 16 times earnings for the same 21% earnings growth. So I think that this is, in fact, going to be the year of the stock picker who can look under the surface. The idea of setting on autopilot and letting the indices take you to paradise is probably going to be a little less well-founded in 2025 than it was in 2024.
Got it. Tom, I know from previous conversations you kind of had that nickname, Turnaround Tom. So I know that value is where you like to be looking. Talk about your methodology. I mean, how do you separate a value opportunity from a value trap?
Yeah, I think that's a great thing to point out, and I agree with some of what Chris said. We do like to see growth, but price is what you pay, value is what you get. So we do look for stocks that are down a lot in terms of price, and then we try to distinguish whether value has been destructed on an equivalent basis. And what we find across most of the durable businesses that we get involved in, number one, they've been around for many, many years. They've operated through many cycles. They're going through a temporary impairment like they have through different cycles, whether they're a cyclical business or they've had different other headwinds in the past. And the first thing that we do is we look for solvency risk. So if a stock's down 50 or 60 or 70 or 80%, the market is saying that there might be an existential crisis. So the first thing that we say is, are they going to make it through this cycle? Are they going to live another day? So that comes down to balance sheet analysis, looking at the debt, looking at when the maturities come due. And if I can get comfortable with that, then the key is going to be leadership. Do they have a new jockey that has a track record of success? That's a key factor. And then finally is free cash flow. Do they have enough runway to execute on the turnaround plan? Because obviously it's been mismanaged to some degree, or the stock wouldn't be down 80%. But these are durable businesses, whether we're talking about Disney that was at one point down 60%. Disney's not going anywhere. Boeing 70%. These are high quality, durable businesses that fell on rough times, but they're not going anywhere anytime soon. So now, to distinguish between a value trap, I think people get caught in that just because the price is down means it's cheap. And that's not always necessarily the case. Oftentimes, a stock that's down a lot deserves to be down a lot and may face an existential crisis. So that's something that you need to be able to discern from experience and doing proper analysis and not just looking at price. And two is doing lazy asset analysis where you say, well, the breakup parts alone is worth more than the price that it's trading at, but there's no catalyst for a recovery of growth. There's no turnaround story. There's no new leadership. And I think that's where people get stuck in quote unquote value traps. And by the way, many of the greatest value traps are broken growth stocks, okay, that never ever recover. People forget that. As it relates to value generally, what I see in the market right now is people blinded by recency bias, in that because since 2010, growth has outperformed value, therefore it's always going to persist, meaning what's happened in the recent past is going to persist. And if you look back to 1927, value has outperformed growth by 4.5% per year, including this aberrational zero interest rate policy environment. And my kind of view there is value and growth are tied at the hip, number one. So it's not either or. I don't buy something because it's a value stock or because it's a growth stock. I buy because I'm getting a lot of value for less price than the alternative's highest and best use of the capital. And I think that unless you believe that we're going back to zero interest rate policy or close to it, not having some element of value and or international, which is also trading at low multiples and small caps, et cetera, is maybe a little risky at the moment if you've got all your eggs in one basket. Because I think we are in a period of regime change, and that's going to create a lot of opportunities, a lot more opportunity in 493 stocks than in 7.
Got it. Okay. Tom, I got to ask you about your first pick. I mean, it's one of those names that just can't stay out of the news, and not in a good way. So sell me on Boeing here.
Yeah, well, Boeing is what we call a legal duopoly between Airbus and Boeing. They deliver 99% of the commercial aircraft. As far as the recent crashes, which have been terrible, they're predominantly concentrated to the older planes. The fear was that it was around the 737 MAX, which has had a ton of problems. But they got rid of the old CEO. Fortunately, we've got Kelly Ortberg in, who has an engineering background versus a sales background or a financial engineering background, and that's a good thing. He's on the floor in Seattle. He's fixing all of the problems. He solved the labor union strike. And when he was at Rockwell Collins before he came here, he created a lot of value for shareholders. Rockwell Collins quadrupled in value for shareholders before it was sold in a period of 6 years. He's a turnaround specialist. They have a $500 billion backlog. I mean, imagine buying a business that had 10 years of demand that they couldn't possibly fulfill, that they didn't have the capacity to fulfill all at once. It's a great problem. You got airlines waiting, and sure, they can get angry and say, the landing gear didn't come down right, or the door had a problem, et cetera, and they're working on fixing all of that. But at the end of the day, they can say, fine, I'm taking all my business to Airbus, and rather than wait 10 years, they're going to wait 20 years for their planes. So that's not an option. What they have to do is work with Boeing, and that's what you've seen, whether it's Southwest, whether it's everything else. And the commonality across all the carriers is they have utmost confidence in Kelly Ortberg's engineering prowess, safety excellence, and turning the company around. So with the stock down, that's down that materially, some 70 something percent. It fell maybe peak to trough. And you have a business that's going to get back to free cash flow positive. They raised $20 billion of cash to take solvency risk off the table. All the components that I look for, turnaround Tom looks for in a turnaround situation, are perfectly in place. Pricing power, durable, sustainable moat, performs through cycles, pricing power. It's all there. You just have to be patient. Now you play the time arbitrage game, and most people can't wait 2 to 3 years for a double. But we're patient. We like to do that, rinse, repeat over and over. And we think Boeing is going to be one of our next ones.
Tom, I want to get back to your last pick. My household may or may not have spent some time on the website this holiday season. It's Etsy. Obviously, a lot of people know what that company does. What's your case there?
Yeah, this is another one of my favorites, down 80%. We like to buy things down quite a bit. But what's very interesting is the price is down 80%. But like I say, price is what you pay, value is what you get. Their growth rate decelerated post-COVID. They had a huge surge in COVID. They are the fourth most trafficked e-commerce site in the US behind obviously Amazon, Walmart, and eBay. 92 million users. But what's beautiful about their business is it's a niche product, handmade, customized, named product. So it's not a race to the bottom in Me Too products where you're just competing on price, which they couldn't compete against Amazon. And Amazon had tried to compete with them years ago and realized they couldn't and got out of the business. So, and then you got a winner like Josh Silverman, who was successful at eBay with shopping.com, founded Evite, sold that to Barry Diller over at IAC Interactive. And then when he was at Skype, he grew 300 million users. So, you have a situation where they made they had the huge growth. They've been able to keep that level of free cash flow, keep the level of peak level of COVID revenues. And it's now trading at about a 9 times free cash flow. So they got so much cash gushing in, healthy balance sheet, a turnaround in plan. They've got this gift mode. They've better curated the website. They're growing internationally. They're focused on men. They've got all these initiatives in place that are getting traction. But at the same time, they're buying in all the float. So they just announced $1 billion buyback. They bought in about 9% of the shares in 2024. So effectively, just from the free cash flow, they could buy in the whole entire company in about 9 years. And that alone, if they didn't grow, but it does look like growth is reaccelerating. And this is the perfect combination of characteristics that we look for in turnaround situations. So we think this is going to be a great one over the next couple of years.
Perfect.
And we're back. So there's not a whole lot more I need to say about the markets. And by the way, 2 of our picks were in here. A shout out to Jeff Adams, who wrote up our Boeing and Etsy from our previous podcasts and articles, was able to consolidate that. You can download the whole report. There are something like 78 picks from 44 different writers in that money show for 2025. Think you'll find that valuable at hedgefundtips.com. While you're there, click on terms. This is all opinion, not advice. Talk to your financial advisor before you do anything. We deal exclusively with accredited investors, qualified institutions, and the like. Want to thank Johan Cherian, Sukriti Gupta, and Carolina Mandel for including me in their article on Reuters this week. And on to our quotes of the week. This is, there's never been a more appropriate time to talk about this, from Jim Rohn, one of my mentors in the 20s. He also mentored Tony Robbins, by the way, in his 20s. Jim was around for a long time. Unfortunately, he passed away a handful of years ago. And his quote was, "Everyone must choose one of 2 pains, the pain of discipline or the pain of regret." And you can't have it both ways. And I think in an environment where you're seeing a little bit of crazy town stuff, happening. And for some of you that were given the FOMO gene, God passed me over when he handed out FOMO genes, thank God, literally. And you're seeing things that make no sense from a valuation standpoint. You got to stick to your discipline during periods like this, because sooner or later the chickens come home to roost, and you don't want to be caught holding the bag. And that's the discipline, whether it's doing your push-ups every morning or not chasing the shiny objects when they make no sense. These disciplines over time compound into really pleasurable outcomes for sure. Charlie Munger, quote, "Our job is to find a few intelligent things to do, not to keep up with every damn thing in the world." No one could say it better than Charlie Munger. I want to talk a little bit about earnings growth for 2025. This has been a theme. You heard it in a couple of the interviews, particularly I think with Taylor Riggs, how healthcare had the worst performance. Healthcare and materials had very low performance in 2024. We expect it to have a great performance in 2025. And you can get a sense of why they had, de minimis performance is because they had de minimis earnings growth. So in 2024, healthcare grew earnings 4.1%. That was, more than half less than half of what the S&P grew, 9.5%, and then materials grew negative 9.5%. So it makes some sense. Even industrials didn't grow that much. It makes some sense that these were the laggards, and what grew, tech certainly had big growth, 17%. We sold off our Google and Amazon that we bought in fall of 2022 during the summer. They didn't do a whole lot more after that, by the way. It was effectively dead money after that. They've started to move up a little bit. And comm services. So they had the best earnings growth and they had the best performance. However, if you look into 2025, two of the top four expected earnings growth are healthcare at 20.5 and materials at 17.0. So that's where there's opportunities. We expressed the materials we talked about through Albemarle. We expressed the healthcare through XBI Biotech. If you recall, during Trump, when he got elected, biotech and healthcare sold off in those 2 months because he was going to rip up the Affordable Care Act. They rallied bigly. As he would say, 75% for biotech in the next year after the inauguration. So that's how we're expressing that. We also have Baxter, which we're excited about. Tech is also going to grow. The key is how much is already priced in, which we talked about in some of the interviews, so we're not going to repeat that. So industrials is going to grow 18.8%. We got exposure to that through the Stanley Black & Deckers of the world, through the Generacs, through the Cooper Standard in a certain way, et cetera. So we've got all that. Energy is going to grow a little bit, but not much. We're still looking for some opportunity there. Consumer discretionary, which we talked about months ago when no one wanted it, they've outperformed. So lots priced in there. But this is where you're going to find the real opportunity and the ones that were left behind that are now going to have the earnings growth. So these things are not mysteries. This is why they outperform and why we get positioned for them. But just as a friendly public service announcement, which we've been talking about for many podcasts now, is not to get faked out right now because Crazy Town is happening. Gulf of America, we're going to co-opt the Panama Canal. Canada is going to be the 51st state and Wayne Gretzky is going to be the governor. Not a bad idea, by the way. And what else are we going to do? Greenland. So, this is silly stuff on a headline by headline basis. Some of it's diversions. There's a semblance of truth to some of it that makes sense, of course. How much of it will get done remains to be seen. But this is the same type of crazy town speculation that you saw after Trump got elected and Trump won. As tariff man, Baba sold off from 107 down to 84. By the way, it's kind of interesting that Baba has done effectively the exact same thing since he got elected, down to the low 80s. And then it over the next 12 months, less than 12 months, it went from 84 to 187 after the election. So it doesn't have to repeat. And this is certainly, not. It's just to tell you that during those weird periods of uncertainty. Same with K-Web. Same with a lot of these. Healthcare, biotech sold off big right after he got elected, rallied the next year, and so on and so forth. Energy did poorly, but I'm keeping an open mind on energy. If something really comes, a fat pitch down the middle, it's just there's not enough upside for me to take the risk right now relative to some of the other opportunities in the portfolio and that we were able to allocate to. So this is just normal stuff. Staples sold off a lot. I'm seeing some staples. I've got my eye on the Hershey's. I've got my eye on the Cokes. I've got my eye on a lot of these companies that have sold off that may be opportunities after the, getting positioned ahead of the election. But we've got that exposure that will benefit from. Healthcare, we're going to rip up the Affordable Care Act afterwards. Huge run, over 50% the next 12 months. And so on and so forth. So everything they thought would do well did poorly, like energy. Everything they thought would do poorly did well. So keep an open mind for the next few weeks. Don't do anything stupid. If you've got cash to put to work, now is the time. If you're picking wisely, the opportunity window that was created by a once in 100-year event, the generational opportunity, the window is closing now. We are set for takeoff, and many of you have strapped on board. And by the way, congratulations to everyone that came this week. Some of you are already approved, funded, and we've been able to deploy in the last couple of days. So super excited for you, super excited for all the clients that are with me, positioned in the same way for a rocket ship. I think this is going to be the most exciting year, not for indices, but for what we do. And we're going to see some charts and correlations that kind of bear that out. So let's go to some of our charts here. This is from Chris Verone. Rare to be December to be lower 20% of the time, but it's January that has the more important role in setting the market's tone for the next 6 months. When January is positive, the average 6-month forward S&P performance is 6.9%. So that's kind of a big deal. As far as when December is negative, it has less of an impact moving forward. So we'll keep an eye on January. It bodes well. This is from my super golf buddy, Kevin P. You know who you are. Played in a bunch of tournaments together and look forward to seeing him when I'm on the East Coast this summer, get back up to the club and knock it around. But what he sent me was this chart of wanted to highlight the report for a beautiful updated version of one of Alphaville's favorite ever chart formats, implied rate forecasts over time and what rates have actually done. So what you can see here is bank estimates of what rates would do nearly every single time sell side was too pessimistic, meaning they thought rates would stay much higher than they actually did. You can see all these estimates and then what actually happened. Rates came down dramatically. All these estimates that rates would be higher, they stayed low, higher, low, higher, low, stay higher, low, stay higher, lower. So, we're kind of we're still in the camp that was a unconventional view last year that rates would they'd probably stop cutting around 3.5% to 4% on the Fed funds rate. But now that's becoming more consensus. So we'll see what happens. But I think this was a really useful exercise that don't be surprised if rates go lower than you think and bonds get bid higher. And no one right now, because you're getting the exact same fake out that we've covered the last 3 weeks in the dollar rally and yields rallying after the Trump election, like in 2016. And then after the inauguration, what happened? Dollar rolled over, weakened for the next year. Bonds got bid, yields compressed. There are zero people talking like that right now. Everyone thinks it's the end of the world. And I think what you're going to find is the opposite is true. Moving along, this is bespoke S&P 500's 2.6% decline was the worst end to a year since 1952. You know, you had industrials down 10% in December. I mean, you had this beautiful broadening from July through December. Then December, you know, after the election and with the Fed stuff, it just, you know, unraveled a acute interruption. It will resume. It's just going to be after the inauguration and things settle down. Yeah, worst end to a year since 1952. That's pretty mind-boggling. Another bullish sign in energy. Let's see. Small speculators are short natural gas for the first time since 2001, just as natural gas was breaking out. This is super exciting, ladies and gentlemen. We love Comstock. Some guy emailed me or DM'd me on LinkedIn. If you have an AMA question, send it in at hedgefundtips.com. Please don't DM me unless you're a client. You can call my cell phone if you're a client, but put it in on the website if you want me to answer it. But I'm going to address it because he said, you know, is Comstock too late to get in? You know, we were pounding the table on Comstock at $7, $8, $9 on this podcast. Now I think it got up to like $19 or $20. And he says, is it too late? I think we're just getting started in the cycle. Now, you know, it's up over 100% in a short period of time. So, but I think if you step back, and we've talked about proved and unproved reserves as it relates to that, it's nowhere near its liquidation value. You saw what it did in 2000. Same type of situation. This thing can run for a long, long time. Would I be a buyer at, you know, $19 after it's rallied from $7 in like a few, you know, in a very short period of time since we've been talking? I'd probably wait for a little bit of a pullback, maybe back to 15 or 16, but you may never get it. And, you know, I will start to evaluate where we are versus intrinsic value much higher than now. But, you know, if I tell you to get in at $20 when I was telling you that, you know, about it at 7, 8, 9, and then it pulls back to 15, you know, most people flip out because they don't know what they own. It doesn't really matter, but if I was late to the party, I'd probably wait for a pullback. And if it went to, you know, 50, 60, 70 without me, I'd be perfectly happy with that. I could care less. So there are plenty of opportunities. So that's not the only one. But it's interesting in terms of sentiment, how people, you know, no one's interested at 7, 8, 9, except for the clients who give me money because they see the opportunities. And they're like, let's go, you know, and you attract what you are. Bottom line, if you're a winner, you attract winners. That's how it works. And that's what I have with my clients. They're just unbelievable group of people that are just crushing it in the real world. And I'm just honored to be a partner with them and grow this over time. So that's natural gas. This is an amazing chart. Okay, so this is all the idiots that are short in the hole. They're going to get their you know what's reamed. And what are we back to? If those of you who've been with me for 2 months, 2001, baby. This is so many similarities. It's so exciting because from 2001 to 2007, emerging markets, China, value outperformed growth, small outperformed large. You can't sell that narrative anywhere, anytime, any place. And you won't be able to until 3, 4, 5 years from now after it's up triple and you get like the guy DMing you after the thing's up over 100, 150%. Is it too late? And then the beauty of those people is that it pulls back. The minute they get in after 100% move, it pulls back 25%. The people that are in from, you know, 100% ago, they don't care. They just wait it out and then they get another double. Whereas the guy who got in late sells down 25% and misses it again, then buys up again. And the same thing's going to happen with BABA. I almost can't wait for, I can't wait for BABA. I just want to see all these people chase up at 200 and that's the story. But corporate net interest payments near record lows. So that is not what you see at recession time. January is historically a strong month for the market, so we'll see if we get some follow through here. S&P annual performance 1953 to 2024. So you can see it wouldn't be abnormal to get a bunch of good sticks together like you got in the late 90s, but we should be open-minded for more subdued returns this year. On the indices, I think on, you know, there was so much money made in 2001 and 2002 when when people were losing 90% of their money in Amazon.com, by the way. It's not because Amazon was a bad business. The fundamentals were still improving. It's just they paid too much money for what would ultimately take place 10 years down the road. People think that if you're cautious on a stock, you're negative on the narrative. And that has nothing to do with it. It's price is what you pay, value is what you get. And I think all of these things that are, happening now with AI and robotics and automated driving are going to change the world. They're just not going to do it tomorrow. And these things are pricing like they've been doing it already for 10 years. And that's why you get the first washout of a cycle, and then you buy it. We'll be buying it when they're quote unquote value stocks, when what they're promising now actually starts to happen. The stocks will be down. When it's actually happening in reality, those stocks will be down 80%. We'll be buying them hand over fist. And that's where you get the real run like you got in Amazon in the post-great financial crisis. Took a long time for that stock to recover. Growth is leading value by 9 percentage points. So what you can see here is that what I talked about with Kristen and others is that this is an aberration right here. This outperformance of growth versus value. This happened in the ZIRP, zero interest rate policy environment. If you believe rates are going back to zero, then fine, you should bet on this persisting. But data going back to 1927, value outperforms growth by 4.5% per year. That's where fortunes are made. And by the way, going back to 2021, remember when you had the concentration of all that tech? Well, for the next 7 years, value outperformed growth by about 100% if you add up all these numbers. So take the other side. I mean, maybe it takes 5 more years for that flip to happen. That's certainly possible, but not probable based on how far the rubber band is stretched. 4-year presidential election cycle, weekly sweet spot. So you have post-election here, a little bumpiness the first half, and then it drives higher. Interestingly, here, so you can see the different indices and so on. 4-year presidential cycle, midterm year weak and sweet spot. So post-election, a little weakness Q1, strong Q2, and so on and so forth. And then the midterm next year should be a lot more challenging. And I would almost think, yeah, we'll take it as it comes. But I'm way more cautious about next year. But wouldn't surprise me if we extend because this bull market is so young. And we had the recession in 2020 and 2022 already, that we get some push forward because you usually get one every 4.1 years. So we got 2 in 2 years, which gives us like 6 years of runway. And we're 2 years in. So I would, let's see how things play out. There are a lot of variables here. I mean, if we ship tanks into Greenland, we might have to reevaluate. Chinese assets aren't off to a good start. What that says about economic stimulus. Oh, why did I post this? Because our friend is back. She must have been on vacation in India or something, because she's back to bash China, and without fail, here she goes. U.S. private construction spending starting to turn up. Percentage of S&P 500 members above their 200-day moving averages. So this is where you want to be buyers, not sellers. Just looking at the odds, above the 20-day moving average. Again, the NYSE stocks above the 20-day moving average. So this is where you saw the October 2000 lows, the fall 2022 lows where we were pounding the hell, and then March 2023. And by the way, we picked up a ton of smart people back then, both in October 2022 and in March of 2023, sending in money when the market was in turmoil because they were listeners of the podcast. I said, now. Just like I'm saying, now, before the inauguration. Let's go. These things are priced for death. This 100-year window is closing, and it's closing fast. And there will always be opportunities, but you're only going to have a once-in-a-100-year event every 100 years. And we are getting the residual benefits of how things positioned, responding to that and recovering from that. That now it's into money-making mode, roaring 20s of the recovery of all these things that got smattered, destock to restock cycle, etc. Active managers selling down, of course, as they always do. Here's earnings estimates. Solid returns are normal after a 20% gain. This is from Ryan Dietrich at Carson. Average after a 20% gain, the average return is 10.6%. That is going back to 1950. So I think that's a reasonable expectation. I've been saying 8 to 12. I like that. 10.6 makes a whole lot of sense. I mean, automotive sales, thanks to my buddy Alan, this is 16.8% annual, 16.8 million annualized SAR. I mean, obviously you had some pull forward with the Florida and the EV tax credits fear wind down, but at the end, if we got anything close to 6.8, I mean, it would just be the thing would at 16.8. If you got not an annualized but an annual 16.8, which I think we're going to get in the next couple of years, Cooper earns over $10 a share because of the $400-500 million of cost they pulled out of it. When they were earning $7 at the last cycle peak, when we were doing 17.1 million SAR, $146 stock, $13 or $14 stock now. As we're ramping up, cash flow positive. So why are they what's the overhang? The overhang is twofold. Rates are spiking up after the election, which they did in 2016 to 2017 after the inauguration. Rates will go back down. That will alleviate fears about refinancing, although they don't have any maturities coming due imminently. But we want to get them refinanced anyway. That'll save additional interest costs, which I think they'll be able to do in the first or second quarter while credit spreads are at record lows. And then it also helps financing on the cars, particularly short rates, which is also a positive thing, which helps volumes. Doesn't help margins for the OEMs, but helps volumes, which is all we care about because we make the certain amount per car, and we make more on hybrids and EVs than we do on ICEs. So as that trend, hybrids are crushing it. We love it. That's more margin than we have in our models. So we're excited. ISM manufacturing PMI turning up. New orders turning up. That's good. And then here we go. Cyclicals over defensives, ISM manufacturing PI. This is going to be a catch-up play. This is going to help industrials and everything else. Here is the number. They expected 16.5 annualized. They got 16.8. This is just super exciting news. Super exciting news. And super exciting news because I've been able to put a lot of new money into it in the 13s, which I never thought I would ever be able to do with 16.8 annualized. So I am super pumped and super. Hopefully, it's going to stay down until after the inauguration because people have these fake fears about tariffs. They'll have some real tariffs, but there are always workarounds and things that can be done and pass-throughs and everything else. But I pray that it stays down for another couple weeks so we can get everyone as much of this as humanly possible at a reasonable price. Hybrids time to shine. So you can see here, this just means more margin than expected. So instead of earning $10 a share, they could earn $12 per share potentially on 17 to 17.5 million, which is the cycle peak every cycle since going 45, 50 years back. It troughs in the 15s, it peaks in the 17s, and the operating leverage of these businesses is unbelievable. Here are the winners by brand. We could care less. Euro. Oh, okay. So all leveraged funds are short the euro. That's going to absolutely rip higher. You're seeing, Trudeau as more and more. Well, I don't even need to get into the reason why. The loonie, a good thing happened this week that's going to help the loonie. Hang in there for those of you who are Canadian. Loonie's going to have its day in the sun here. Just remember back to 2001 period. Commodities, you can't versus global equities, can't give away. Same in 2020 when we were buying Exxon in the 30s when oil was trading negative. So now it's the Albemarle's of the world. It's other opportunities to play the commodities trade. Comstock, of course. And this is what helps the emerging markets countries and the emerging markets currencies when this inflects, which it will, which it shall, which is also a function of Chinese stimulus and everything kicking in there, which we're going to cover. CTA's exposure to oil short in the hole. I think oil's going up. Selling pressure in the energy sector. There you go. Selling in the hole. Most crowded longs index. So look, it's it's in overshoot mode. It can stay extended in overshoot, but you don't have to play. The pain of discipline or the pain of regret, your choice. This shows expensive relative to the last 10 years versus cheap relative. What's cheap? S&P 400, which is mid. S&P 600, which is small. And what's expensive? Growth and momentum. So you can chase the shiny objects and be undisciplined and hope that there's another sucker that comes in behind you to lay it off to, but chances are you'll be holding the bag. That's what I have to say about that. Global valuations, current and 25-year, next 12 months price to earnings ratio. So this just shows China's the cheapest relative to history, and relative in absolute terms, U.S. is the most expensive. Keep that in mind. When we covered the U.S. versus international cycles from Callie Cox over at Ritholtz last week, that was an awesome chart. Go back and review that if you want to think that U.S. is going to outperform forever. Then you have a very myopic short-term view grounded in recency bias, and that's where you get punished. Moving on, corporate spreads. This is where miracles happen. Refinancings happen. Interest expense for companies is at the lowest in years, as we covered. And as a reminder for the shiny object crew, South Sea stock bubble. This is from December 1718 to December 1721. This was Isaac Newton, not a dumb guy. He got into South Sea stock, bought a little bit. He exited at a profit. He bought a little bit at 200, exited at 400. His friends got rich at 600. He enters with all his money at 800. It goes to 950, and then he exits at 200, flat broke. And this is exactly what you're going to see with Baba. Is basically what's going to happen. But what's more likely is that, most people will enter here, sell on these pullbacks, then buy up again, sell on the pullback, then buy up again, sell on the pullback, then buy up again, sell on the pullback at a loss, and then start buying and get smoked. So it's not about being smart or knowing better. It's about observing history and learning. You can learn from your own mistakes, but it's a lot more cost effective to learn from watching other mistakes. And there's so much written about mistakes throughout history. If you'll take some time to educate yourself and experience, and nothing beats experience, but experience coupled with knowledge, it's an unmatchable combination that can just set you up for a lifetime of happiness, success, and enjoyment. Let's just put it that way. Trump aids ready universal tariff plans with one key change. This was put out, then rebuked. It's probably a lot of truth to it. He said, but only on certain sectors. So it looks like the administration is walking back the blanket tariffs that had the whole market worried. Canadian dollar jumps on Trudeau and tariff reports. So that was a spike up on the tariff announcements and the Trudeau resignation. Valuations get more lopsided, more of that. This is S&P equal weight versus the S&P 500. This is what technicians call a double bottom. So you had that monster broadening from July through December, then the abrupt interruption. And this will resume and finally break out, and I think 2025 is that year. This is S&P 500 risk premium. Everyone keeps talking about this like it's a bad thing. Next 12 months forward earning yield minus the 10-year treasury yield. And what that implies, so they're saying, oh, stocks are expensive, bad time to invest. No, the stocks that are driving the multiple, i.e. the earnings yield, are too expensive. And what happened during those periods is value, small cap, emerging markets, international, all the things that were cheap took up the reins and dramatically outperformed for the next 7 years. So this is bullish as hell if you know what to buy, or you pay someone who knows what to buy, a part of the profits to do it for you. That's a home run. So change in 10-year treasury year seasonality. So there's a tendency in the post-election year to have some strength in the yields until early March. So maybe it persists a little after the inauguration, but I think we're pretty much there. When everyone's convinced we're going to 5%, it means that the move is probably done. Presidential cycle and returns, year one, average 6.6. Median is 8.1%. That's going back to 1928. This is Russell growth versus Russell 1000 value. And you can see this, this whole thing of the zero interest rate policy where growth outperformed is the aberration, not the rule. I can't reemphasize. Look at this from 2000. Value outperformed growth by 29%. All right, let's put it the way it's written. Growth underperformed value in 2000 by 29.4%. Growth underperformed value by 14.8% in 2001. Growth underperformed value by 12.4% in 2002. Growth underperformed value by less than 1% in 2003. In 2004, growth underperformed value by 10.2%. In 2005, growth underperformed value by 1.8%. In 2006, growth underperformed value by 13.2%. So this is the norm. Same in the 80s under Reagan. 81, growth underperformed. 83, 84, 86, 88, growth underperformed. So there you go, ladies and gentlemen. Moving along. Cumulative flows into ETFs as a percentage of AUM. Money's moved out of commodities in mass since 2022 till now. So there's going to be a pony in that pile, just like in 2001. This month's calendar configuration has historically resulted in meaningfully slower overall payroll growth. So tomorrow's payroll report, like I talked about with Kristen, if that comes in softer like the ADP report did this week, that is going to put a cap on yields, and that's going to change a lot of dynamics. So just suck up the fits and starts for the next couple of weeks. It's just going to be crazy town with headlines. It's the way Trump likes it. And then we should get back to some normalcy and some beautiful rotation action. Big, beautiful rotation. Make rotation great again. So alternative measures of employment growth slowed in December. So again, that would imply a softer number tomorrow, which keeps the Fed in the game, which puts a cap on yields. All good. All right, pairwise correlations on a 12-month rolling basis have fallen, suggesting a more attractive opportunity set for alpha generation. You don't get these correlations this low until you go all the way back to 2017, right after Trump got elected, by the way, and all the things that took off, which we're positioned for, and then going back to 2001. So look, these things don't repeat exactly, but they rhyme like crazy. And if you could just pay attention to patterns, it's not rocket science. The Magnificent Seven is expected to generate earnings growth of 33% in 2024, which we talked about. The rest of it, S&P growth 3%. So why did Mag 7? They dramatically outperformed on earnings in 2024, but that's changing now. The Magnificent is going to low double digits. The Mag 7 is decelerating. Actually, this is crazy town. I thought Mag 7 was decelerating to 21%. They're decelerating to 18%, and they're still trading at 33 times, whereas the rest of the market is probably trading at 17, 18 times with 11% earnings growth. And then next year, Mag 7 decelerates again to 16%, and Unmagnificent 493 accelerates to 13%. So I don't need to, here's all the countries. Cheapest is China, most expensive US, just another way of looking at it. 10-year Treasury yield prior to first cut and plus 100 days. So historically, you get this bump and then a weakening on balance for the biggest weights. This is very interesting. Treasury yields see boost from Trump tariff threats. So you haven't seen this type of short-term boost. Actually, this is wild, ladies and gentlemen. Every time, so remember we were pounding the table the fourth quarter of last year by TLT, and it rallied like crazy off those lows. Okay, so that setup is here again. So this is a different way of viewing it other than the commitments of traders. And then when does it happen again? It happened again in right here after the election, before the inauguration, and then boom, yields, bonds rallied, yields compressed. So I don't know how many different ways to tell you other than I hope you're listening, and I know we're all going to benefit. So that's why we do this every week. Here we go. Here's Slumer over at RBC. Thanks to my buddy over there. What do we got here? Okay, so this is the S&P 500. Yeah, I think these things, that's basically the Mag 7 now. They got to consolidate. It's bouncing back up here. Okay, so that's the daily. Here's the equal weight. This looks like it's putting a double bottom, ready to move back up to 188. This is the NASDAQ kind of hanging out here after a breakout. We'll see what happens with that. Then you've got the Russell 2000s broke out, came all the way back in December to check. I think this is going to be the story in 2025. Sentiment is weakening a little bit. Then you got Europe has just been grinding sideways for over a year. I think that breaks out this year. That's ex-US. Tokyo, weak, not interested. Hang Seng, again, we came off those lows in early 2024. And then we check back at the end of the year. I think this is just a stair step higher over time, and then just completely crank higher over time. 10-year yield. So, it's up here against this resistance. I think we're pretty much there. If we get a few more weeks of hovering up here below 5, so be it. Just to bang out all the people, short in the hole, suck in more shorts, and then absolutely roast them all. God bless them. I can wait a few weeks. Not a big deal. So that's that. And then you got the dollar, same story here, up against resistance at this 61.8. If that means anything, I could care less. A few more weeks, suck in a lot more longs, and then just roast them. And then Canadian dollar starting to come off the boil after Trudeau. I love these overshoots. It gets, it's just part of the game. Crude's taking a little bit of a bid here on the daily. That's expected. Gold has been weak. Everyone wanted it in the fall. Now it's let's see how that works out. Copper, I think this is going to be a long story, just like in 2001. I think the China stimulus, they've been pushing a ton of stuff in the pipeline for a year and a half. It's been piecemeal, but it's adding up materially, and it's all going to hit at once, and no one's going to be prepared for it. And they're going to say what happened. And when a lot of these stocks are going to double in a year, and everyone's going to be interested. In 2016, the best ideas are going to be China. They're all going to be touting China and international after 100% move. And that's the good news. I mean, I don't know if I don't think 100% move is enough for us to be sold to you. So we'll ride their exuberance for another year, and then we'll just lay off to all the Johnny-come-latelys. But all this stuff is just playing out as anticipated, with a little overshoot on a couple, but there we are. Semiconductors consolidating. NVIDIA, we talked about with Stu. 30, 40 times sales, 50 times earnings, decelerating growth. Assumption that there will never be competition, except every single semiconductor cycle for the last 40 years, competition always comes. A lot of people betting on this times it's different. Why? Because of recency bias, because, they weren't even through puberty the last semiconductor cycle, and, it's where we are. Applied materials. Okay, so that's that. Anything else we want to see on this? Merck, I kind of like these drug stocks. I like these big drug stocks. Pepsi, some of these things. We're not doing anything yet. Colgate, probably interesting. Hasn't come down enough for us yet. That's a great long-term business to own. Set and forget, dividend aristocrat grower. A lot of these things haven't come down enough, these high flyers. This GE story is perfect. We were pounding on GE. No one was listening. I will say that I think this is going to be very similar to the Boeing turnaround story. It's when everyone's given up on it. That was the case with GE for sure. And then the new CEO turns it around, and Kelly Ortberg is the guy. Rockwell Collins, four bagger in 6 years with Rockwell Collins, wealth generator, turnaround specialist. As you can tell, we bet a lot on our jockeys. All right, so that was good stuff from Slumer. This is just keeping in perspective what we've been talking about since 2000 is we're only halfway through the cycle. Everyone was panicked here. I said, we got 10 plus more years. Now we've got 6 plus more years. And That's just the way it works. It's demographically driven. He doesn't really go into the demographics of it, but you basically have Gen X, which was a smaller generation than the boomers. So you get this 15 years of consolidation. You went from 80 million people to 65. That's why you get this. That's why the Fed could print unlimited money with no inflation. Now the game has changed. You got 12,000 people turning 35 every year, buying houses, cars, babies, washing machines. All that stuff's going to continue for 5+ years until they're 40 is when the spending slows. Same thing happened in the 50s. Same thing happened in the roaring 20s, and so on and so forth. And then we'll get extremely defensive in the early 2030s, and we will take the fortune that we make over the next 5-6 years for clients and for ourselves, and we will be able to buy unbelievable businesses, forever businesses at 50, 70, 90% off. It'll be like it is right now for certain sectors. It will be for many sectors, and that'll be unbelievable run. So in the early 30s, if I'm in cash and the market keeps going up and up, and I'm talking about shorts, and you're going to say, Tom's lost his touch. He used to be so optimistic. What happened to Tom? He was one of the greatest equity investors, and now he's just this pessimistic short. What happened? And then by 2034, you'll be like, oh, okay, all right. So turnaround Tom is often early. By the way, turnarounds work both ways, ladies and gentlemen. Sometimes early, but over time, mostly right. You'll know what's going on in the early 2030s when I'm less pessimistic. That's a lot less fun. I think the next 6 years is going to be a lot more fun, but there we go. Emerging. Okay, so someone sent me this. Emerging stocks enter correction as traders weigh U.S. policies. I'm not really going to comment on it. I'm just going to show you a chart, and you can draw your own conclusions with these dog shit headlines. So does this look like something you should be dramatically worried about, or does this look like something that you hold? Because if you were down here buying in the hole when absolutely no one wanted it the last year and a half, China, emerging markets, everything else, when we pounded the table every week, it's made progress, not nearly as much progress as we know it's going to make, but it's no different than it was in the early 2000s, ladies and gentlemen. You saw this type of thing, then this fake out, and it comes back, and then it just it kind of checks back, and then you get these parabolic moves. And I think we're setting up for something similar here. So these are the type of things to take you out of your stocks at the exact wrong time for stupid people who don't do their own research, get faked out by stuff like this. So thank God, and that creates opportunity for people like you. FMC shares pop as KeyBank says sell-off is overdone. This is in the materials space again. There's just so much to do in materials. We're looking at Dow Chemical, Celanese. It's unlimited. FMC, Scott's Miracle-Gro, Mosaic. We're not doing anything with that one for sure. But there's going to be a lot of money made in materials this year. So Baidu founder Robin Li predicts exponential boom in AI apps for 2025. Well, thank you for the prediction, but being that Alibaba is the number one player, we will be the number one beneficiary, so appreciate the optimism for your competitor. Bloomberg, China's PBOC vows more support for innovation and consumption. So again, they just keep pushing the ball underwater. When their hands are released, the ball will absolutely pop. GM Ford report best annual U.S. sales since 2019 as auto recovery continues. I love it for Cooper Standard. People aren't paying attention, and you get that opportunity as we have been taking advantage of hand over fist. PBOC reiterates China cut rates, reserve ratio to be cut at appropriate time. When is the appropriate time? Right after the inauguration. Natural gas stocks have momentum and cold weather. So this is everyone getting excited after all these stocks are up more than 100% in a few weeks. Take Warren Buffett's advice. Don't buy any stock in 2025 unless it passes this test. 2 very simple tests. Number 1, Buffett first determines whether he can sensibly estimate an earnings range for 5 years out or more. The only type of companies you can do that in are not in high flyers or IPOs or new technologies where you're guessing and praying and hoping and chasing the crowd, but for durable businesses that have been through many cycles, that have a proven moat, and you can understand the cyclicality and how the fundamentals move relative to the price. The fundamentals may deviate 5, 10, 15% if it's a big turnaround, and the price deviates 80%. So we love that. I mean, that arbitrage I'll play all day long for the rest of my life like nobody's business. It's what I love to do. I'm good at one single thing, this tiny little narrow lane, and I don't deviate. I really don't do private deals. I don't invest in it. I just eat my own cooking. Everything I do, everything I talk about, it's where I put all my money. All my money is where my mouth is. And then the second test is to buy a stock only if it trades, quote, at a reasonable price relative to the lower end of his historic earnings range. He will buy a stock only if it's reasonably valued using this approach. Again, if the stock doesn't pass this second step, he moves on. So, I have a different filter, which is pretty much the same filter. Number one is so I'm more about protecting the downside. The upside takes care of itself. If this stock was to go to zero, would they take me out on a stretcher? Because there can always be things that you don't know, and there's no way you could know. So that deals with sizing and risk. So if you have a high conviction 8, 10, 12% position and the world ends and it takes you out, you got your other 9 that are doubles or triples over the next few years using the same framework. They're going to more than amply compensate. The good news is, the de minimis probability of that ever happening is so small, but you have to hedge against the possibility of ever happening. So that's number one. Number two is, if I was to walk into the boardroom of this company and offer to buy the entire company at the price it was currently marked in the public markets, would the board call security to have me escorted out of the building because I was absolutely crazy and insulting to offer to buy the company at that price? And if the answer is no, meaning they would take the meeting because they think that might be a fair price, then I'm not interested. I'm not buying it. And that you just learn with experience over time. And that's why they call me Turnaround Tom. Chinese companies have sidestepped Trump's tariffs. They could do it again. Ulta Beauty stock jumps. New CEO goes a long way. It's another one we've got our eyes on. My kids are in Ulta and Sephora all the time. China's central bank outlines monetary policies for 2025, emphasizing expanding domestic demand, of which Alibaba is the number one toll taker for the middle class and upper class. Quality items, Temu sells the garbage, disposable crap to poor people. And their numbers, as we've said for many months, either unsustainable, which is now proving to be the case, or unreliable, which we shall see. Stabilizing expectations and stimulating vitality to ensure sustained improvement in the Chinese economy. AI has a cost problem, what it means for the other stuff, for the stock market, and 5 other things to know. So what they're just saying is that every $200 a month subscription that Sam Altman sells, he loses money on because every search query costs 10 times the cost of a Google search, and $1,000 of computing power per task. So it's just a losing business. And then the people that are buying all these chips are not getting an ample return on investment, which is why you're getting decelerating earnings growth. All these great things are going to come true, okay? Just like all the great things that Amazon have done have come true. The difference was Amazon fell 90% from 2000 to 2003 or whatever it was, despite fundamentals kind of improving, because people were already paying as if all the things that came true over the next 15 years were already happening. And it always takes a little longer. All these things take a little bit longer. So getting in on the second phase when people have thrown in the towel is really a great opportunity. China confirms Xi Jinping and Donald Trump have been in touch since the U.S. election. Trudeau resignation opens the door for Trump going easier on trade tariffs with Canada, especially if Wayne Gretzky becomes governor. You can't make this stuff up. I think Gretzky would be great, by the way. You know, he's a winner. What else do you want to know? Disney inks deal to combine Hulu Plus live TV business into Fubo. I like this deal. I use Fubo because they have better sports than YouTube TV. I liked YouTube TV. I use Fubo, and they let me screenshot some of the things when I do TV, etc., which YouTube blocked me and all that stuff. So they're too cute by half. And the interesting thing was I kept looking at Fubo to buy, and I just couldn't get my hands around it. I'm like, they're kind of, kind of flailing in the wind. And now with this deal, we own 70% of Fubo through our ownership in Disney. I love this. It's just like all the great things we own through Alibaba without actually having to own it directly on a standalone basis. So this is a home run. And that's that. So Bob Iger strikes again. Good job there. Disney stock gets an upgrade amid content renaissance and streaming profit growth. Remember when we got involved, 70s, 80s, you couldn't give it away. People said the streaming is losing money. It's never going to turn. Well, they did it. They turned profitable. They're huge. Same story over and over. We had to go through the whole Bass family to convince you and this and that. This happens every cycle. But that's what Buffett's talking about, of being able to estimate the turnarounds and the cyclicals, because you see these things happen over and over again. They just found a new way to sell the content. Their amazing content library in 1984, when the Bass family took a huge position in it. They went from movie theaters to VHS. Then they caught another run in the 90s with DVDs. And now they're catching another run with streaming. But streaming is better than DVDs because it recurs every single month. You weren't selling someone one new DVD every single month guaranteed, which is just beautiful. So Fed isn't certain where interest rates will head. Minutes show inflation and Trump are concerned. So my guess is nowhere until probably June, but let's see how it goes. China ramps up yuan, unless if the labor market starts weakening a little bit, they will be all over that and cutting again in March. They seem a little bit more worried about the labor market than inflation. China ramps up yuan support with record Hong Kong bill issuance. So they're on it here. We're ramping up just in time for people to be on the wrong side of the trade. So here is the power up stock market and sentiment results. We covered all the media. Wanted to do a Generac update. We haven't covered that a lot because we, if you've listened for a while, we don't spend much time talking about our winners. We've been talking about Generac since well below $100, and then it shot up to $195. Now it's at $160. Look, all you need to know here, we can go through every word of the transcript, which we did, but we don't have time for that. Is free cash flow is accelerating, and free cash flow is now at the levels you saw when it was a $524 stock. It's at $158. So, getting back to 200 and beyond is easy peasy. And then the question is, where does the growth stall out on the next cycle? Is the stock 250? Is it 300? Does it get back to new all-time highs? That's going to take a while, I think, new all-time highs. But this is the same story over and over, and they continue to bring the share count down. Earnings are recovering after a trough in 2023. They worked through the destock cycle. Now we're back into the restock cycle. Going to be at record earnings by 2026, 2027. Free cash flow per share is going through the roof. Sales per share have reaccelerated to all-time highs because they brought in the share count, and they're just dominating. Residential, commercial, and industrial, you see them every single way. And they got their hands in the whole eco stuff that it's kind of a waste of time, but they got to be there as just to block out competition. And this is the cycle of Generac. They have these huge growth runs like they did into 2021. They consolidate for a few years with a little bit of lower revenue. They recover after a couple down years, and then back to the next growth cycle. Same thing, rinse, repeat, and that's where we are right now. Just like Boeing, no different. U.S. penetration rate is only 6.25%. You can see some of their other states are at 21 to 25%, like Michigan, West Virginia, Maine, Louisiana, where they have regular outages. Everyone has one. Every 1% additional penetration. Look at California, 0 to 3%. I mean, you think California is going to sell a few generators in the next few months? You bet your bottom dollar when they're shutting power off in Los Angeles. Every 1% is a $3.5 billion opportunity. So, you get 14 more percent penetration, or let's just say $35 billion opportunity. I mean, that's where fortunes are made, ladies and gentlemen. And, the most important chart here, which actually blew my mind, first one, I love this one, obviously. Sales recovering, margins recovering, free cash flow just off the charts, almost $500 million of free cash flow for 2024. You can't give it away. I love this. Well, some people started bidding it. It was a double, and now it's come back a little bit, so you can give it away. People were taking it at 194. But anyway, this is what's really cool. Because I'm like, 6% penetration, what happens? This is the adoption curve of central air conditioning. It looks a lot like it. From 1945 to 1950 to 1960, the first 15 years of central air conditioning, the penetration rate was only 6.25%. Which is basically 2005 to 2024 of generators, home standby generators. And then it just completely hockey sticked after 1965 and went straight from 10% generation penetration to 88% penetration. I think with what you're seeing with the grids and the demand that AI is going to have on the grids and everything else, and air conditioners and everything else, the instability and the weather and all that stuff, I don't know if we ever get to 88%, but I would be surprised if we didn't get to 30 or 40% over the next 10, 15 years. You see the same adoption curve with home security alarms. We're basically at 0 in 1980. Within the first 20 years, got up to 19%, now at 29%. Portable generators went from 0 to 20%. So, and then home standby generators. So I think more and more, I think this is going to be a feature when people build new houses as well. In a more meaningful way. You see residential up 27% year on year. If you look at last 12 months, up 10.4. Net sales up 9.6% on the quarter. Gross profit up 9%. Net income up 88%. Free cash flow up 56.5% year on year. And last 12 months, free cash flow up 178%. Pretty exciting. Free cash flow last 12 months, 584. So 9 times, anyway, so this is exciting. Here's the fear and greed index. This is not what you see at tops, really. Could it go lower before it goes higher? Yes. And then finally, congratulations to all the new clients that came in during our 2024, well, let's just say all of our raises and our first week of our Q1 2025 opening. You cannot be better positioned for what we believe will be a very highly rewarding year in 2025. This view is based on much of the data we've shared in recent weeks on our podcast VideoCast, as well as our proprietary methods of expressing and executing upon those views on your behalf. We reopened to smaller accounts, $1 million plus again starting last week, because we want to be fully positioned as soon as possible before the inauguration, based on some of the data we have referenced on recent podcast video episodes, and will remain open for the next couple of weeks. I don't know if at this point we're bumping up. So it's probably not going to be 2 full weeks, but something like a week and a half, but close no later than the inauguration. And that's probably too late. Congratulations to all I had the pleasure of speaking with and onboarding in the last week or so. After we opened up, we begun deploying capital on your behalf, in a material way. And if you're still in the process of the application approval, you can call them directly. It usually takes 24 to 48 hours. And then we can start to deploy once that hits. To see if you qualify and take advantage of that, you click here. Larger accounts, 5 to 10 million, can access bespoke service at their preference at any time. So that's that. It's opinion, not advice. Do whatever you want. Talk to your financial advisor. Let's talk about earnings. Are the name of the game. Tech revised down by about 1% in the last 60 days, top 30 weights, and communication services. Again, both of these trading at the highest multiples. Communication services was revised up 72 basis points. So nothing material on either of those. And now on to the Ask Me Anything question. So if you are a fan of the Ask Me Anything question, stick around. If you just like the podcast, thanks for tuning in. Let's start with number one from Chris C. Uber Technologies. Let's take a look. This is not the type of, I can't really predict who's going to win. You know, you see all these Waymos driving around without drivers. Look, I mean, Dara is running a good business. The cash flow continues to grow. There's nothing wrong. I just have to guess the future on this one, and I don't like to guess the future. So for me, it's no. I think it looks reasonable at a glance. I think it's more of a trading vehicle than something you want to be in forever. But, you know, why am I getting this question at 60 instead of at 20? That's when it was an interesting one. So that's not for me right now. Now, it could be 100, could be 300, could be all that stuff. But I'm not going to guess the future. I just like things that I can predict with reasonable certainty. Stigen Achen, Tom, I'd like to hear your thoughts on both Burberry and or Kering. Both luxury plays have been beaten down. Both change CEOs, creative directors, potential return to Chinese consumer. Is there room for a turnaround? I think so. I mean, we get a question on Keurig, on Burberry every single week. I've looked at it a few times and I've continued to say no, because even when China was doing well, the stock couldn't get out of its own way. It's done nothing for basically 12 years. So for me, and I think that's consistent with the fundamentals, I think it's just a dead brand. You know, maybe you can get some miracle worker in there and get a pump for a couple years. But look, free cash flow is well below 12 years ago. The reason the stock's gone nowhere and nothing's happening is because the cash flow has gone nowhere. It's gone down. Revenues have gone nowhere. They've gone down. So just because the price has gone down doesn't mean it's a cheap stock. So for me, no real interest. Keurig might be a different story. Kerig. Yeah, this thing is still in massive distribution, but it's definitely probably more interesting. Kerig. I mean, this is not a mystery. Like the stock has really gone down with free cash flow. So you got to understand the turnaround situation. Looks like cash flow is starting to recover a little bit. Let's take a look at, I think this one, let's see. Fashion leather goods. Okay, Gucci, Saint Laurent, Montana, Balenciaga, Brioni, blah, 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 blah. Yeah, this is kind of more interesting. It's a little more diversified than, yeah, I mean, it's trading 1.5 times sales. 2 times price. Oh, you got a dividend on here. I mean, if you put a gun in my head and said pick one, I'd say Keurig for sure. But I don't think this thing's going to turn around right away. I think this is going to take a couple years to find new buyers. Could be wrong on that, but you know, this is a lot of institutional destruction. It's going to take a long time to rebuild a share base. Kyle Meacham. Hey, Tom, you mentioned last week that a lot of yen carry trade funds are focused on the Mag 7. Yeah, I mean, look, if they're in the S&P 500, they're focused on the Mag 7. So bottom line is, when the yen carry trade unwinds, the thing that's going to get hit the biggest is the heaviest weights, which is the Mag 7, which also has another reason, which is decelerated earnings growth. So nothing new there. What do you think about GPC? I know you're invested in autos like CPS and AAP. I mean, GPC is a better quality business, but you have much less upside with the same amount of risk. So I know that mommy and daddy tell you to buy the best quality company in the industry. And that's perfectly fine and good advice. But if you're looking for doubles and triples over a few years, you're not going to get that when everyone's already seen what you see and the stock is fully priced. So for me, it's a pass. But if you bought it and held it, I don't think you'd really be disappointed, but you're just not going to get doubles and triples. Jessica Lilly, thank you for all you do. You're welcome. Thank you. I thought I would chime in as I've been a nurse for 25 years. When Baxter's manufacturing facility went down due to weather, we were completely backordered on IV fluid and no facility anywhere I talked to could get fluids. It shows you that they basically have a monopoly on IV fluids. So thank you for that feedback. Marek M. Since your interviews with Kiko, then David Lim to become okay. What kind of economic? Oh, you seem to be overall bullish on 2025. What kind of economic data, surveys, yield curves would you make you reevaluate your current stance? Decline. Earnings coming down materially. What opinion would make you feel wrong? So Marek is, reading all the doom porn blogs, I'm sure, and they're all telling him, get out of your stocks, blah, blah, blah. I don't want to be in certain stocks. I definitely think there could be stocks that get hit hard. I know what the margin of safety is in my stocks, and literally the market could collapse 50% tomorrow, and I wouldn't feel uncomfortable in any one of my positions because I'm buying them with such a margin of safety. Now, might the price get impaired for a short period of time? Sure, the price could get impaired for a short period of time. But when you're running on low to no leverage, it's not an issue. It's you still own the same percentage of the business, and et cetera. So, for all these people saying the yield curve is inverting, we're toast, we're going to have a recession. Let me remind you, we had the recession that everyone is looking for in 2022 with 2 quarters of negative GDP growth, which followed a recession in 2020. We had 2 recessions. That is the definition of a technical recession in 2 years. Average is 4.1, so we pulled forward 8 years of recessions in 2 years. We have runway. We have liquidity. When the facts change, I will change my mind. Right now, there's nothing that supports that fact other than a bunch of people trying to sell you clicks and take you out of your stocks at the exact wrong time. Now, if your portfolio is Palantir and NVIDIA, good luck. You may experience a depression while a good portion of the other stocks go up. Or you may experience a double. I can't predict that because I can't value it. I cannot predict the future, so those are not stocks for me. And again, I will say and continue to reiterate, there are many paths to the top of the mountain. My path is not the only way. There are plenty of ways to make money in and out of the stock market. I just do the one that I am very good at and that I have confidence and I can sleep like a baby at night because I know what I own and they have relatively predictable business models, cash flows, revenues, etc. Now, you can go into the prediction game and make a ton of money, gamble, and you're right. You could also hit, 31 on the roulette wheel and, multi-bag your money and your bet. But the odds of reliably predicting the future and guessing on the next technologies are limited, which is why Buffett never did it. And he was the greatest compounder of wealth in the history of humankind. So, okay, Jesse James, question on TMO. As you think healthcare would recover, would someone do well buying some more high quality life science like Thermo Fisher? I think Thermo Fisher is historically a pretty good business. So again, this is a 15 bagger in 10 years. Where were you at $40? Why now? I mean, let's take a look at the fundamentals. Doesn't mean it can't be a 15 bagger again, but odds don't favor it. So cash flows have been flat for 4 years. It's fully valued. It's an okay business, but I mean, this is the type of thing that if you're lucky, it goes from 544 maybe to 750. But if anything goes wrong, this thing could fall to 250 in a minute. So like you're okay, but I just don't see the I look for asymmetry. So for me, there's no asymmetry. Like there's always the risk of what you don't know that you don't know in a stock. So a business that I'm going to get like a 20-30% return, and I have a possibility of there's something out there lurking that I don't know I'm not interested in. Like I have to get paid double, triple, quadruple plus for me to take any risk with capital. And then I have to know my downside is totally protected. So solvency risk comes first, then cash flow, then revenue, then understanding the cyclicality, then understanding the management, then understanding the durability of the moat. So for me to do all that work, I got to get paid, baby, and it's got to be a double, triple. So for these type of things, it's not interesting to me. But thank you for sending in a great question, J. Smith. Take a look at EW. Yeah, we keep looking at EW every week. EW is fine. But again, show me how the cash flow is going to recover because it's absolutely collapsed. So this probably will recover. I just it's worth doing work on for sure. It's an okay call. It's an okay call, but you got to do your work and really understand how durable are their products. I think it's a pretty solid compounder over time, but for me, it's a not. I don't have any urgency to do a lot of work on this one. I'll just leave it at that. But it's interesting. So I think your framework is good. You just need to get some confidence in how they're going to turn around the free cash flow story. And if you can get it towards that inflection, you know, you might have a double over 3 to 5 years on this, but more likely 50 to 75%, which doesn't really pass my IRR hurdle. Dan Abbasi, thanks for sharing your knowledge. Could you take a look at WNS Holdings? Okay, so this thing is halved. What do they do? Cash flow has been flat for 5 years. Stock price is basically trading where it was 5 years ago. No shocker. Gross margins. Let's take a look here. First off, what do they do? Voice analytical business transformation services worldwide. Package good. Such as customer service, analytics, human resources, outsource. They do like 80 different things. I can't even understand this. So if you can actually figure out what the hell they do and how they're going to get this thing to reaccelerate growth, then I'm interested. Just on the basis of what I'm seeing, it's not motivating me to do any further work on it, to be honest with you. So it does look like a good trade, but I'm not that interested. Reload the page. Let me just see here. Balance sheet. Get this a little smaller. Okay. Oh, that didn't help. Okay, let's see here. 240 liabilities, 102, that's fine. Income statement. Income is growing. What's happening to share count? Nah. Let's see. Share count's okay. Let's see what's happening to margins. It's holding up. I do a little more work. I would say that you have to understand, why is it down? And what is the plan to get cash flow growing again? Make cash flow great again. They have not been doing that. So what's the plan? That's the name of the game. Oleg Shakarov. Thoughts on Nike? We've covered this every week. It's fine. We like VF better for the same reason, because it's not an easy double like many of the other things that we're in. You'll just get a decent trade for a lot of risk. Don't understand why you picked CCI over AMT, because again, Miriam, I'm not in things for 30-40% returns. I'm in things for double minimum, and you're not going to get that from the quote highest quality business that's already fully priced. We're looking for leverage without taking leverage, so that when everything turns, we get the most bang for our buck, and we get asymmetry, not an incremental return to something that's fully valued because everyone already knows it's the best business in the group. You know, Advanced Auto Parts is the shittiest auto retailer. We know that. We're not blind. But it's the only one that the last 4 times it had $630 million of operating income. It traded between $180 and $220. And that's management's target, new management, Catalyst target for 2027. And the stock's $45. So that's that. Okay. Mr. Hayes, I know main focus is China for emerging markets, but what are your thoughts, outlook on Mexico? Not for me. I mean, maybe I'd buy Walmart Mexico or something. I haven't even looked at it, but no. Too much turbulence. Trump is going to be like bashing them every day for paying for the wall, taking the wall down. I have no idea, but it's not going to be fun for Mexico. But I do think Mexico's demographics, business, everything is great. I just don't really want to invest there. Griffin Brown, I just graduated as a public investor. As a private investor, you know, would I want to set up a factory there? Yeah, but I'm not a private investor. It's not what I do. I just graduated college. I don't know. This is like a 5-page question. How do you feel about Nike? The same way I feel every week. It's good, not great. It's going to work, but not as much as some of our others. Thank you for the question. Griffin Brown. Okay, so thank you for that, Griffin. Good stuff. All right, moving along. Daniel Borkman. Daniel, we cover TLT and bonds for like an hour every single week for the last 3 months. So go back to that. Look at the commitment to trader stuff we talk about. Look at the cycle stuff that we talk about. Look at the positioning stuff that we talk about. And you will realize why we have that view. Also, in terms of BABA, what do you think of JD? I like BABA. I like BABA better than JD because BABA has the #1 AI business. If you want to own a piece of every single AI startup in China, you want to own Alibaba. If you want to benefit from AI apps and compute demand going exponential, you want #1 cloud provider, BABA. If you want to benefit on a recovery of a middle class, you bet on BABA. Tollgate for all consumption, you bet on BABA. JD, you only get one of those. So if I'm a poker player, which I am, you want outs. And with BABA, you get the most outs. If one thing doesn't work as well, there's like huge opportunities. The international is growing at 30+%. It's priced at like it's not, like it doesn't even exist. So that's why I don't want JD. Or if I had to pick one or the other, I mean, you could buy a basket, you could buy JD also, it's probably fine. But Dak Brown, notice you don't have any ads on your podcast because that's not what I do. All right. Lucas Trengove, been listening a year and love what you do. Found 3 stocks. All right, Lucas. There's no question there. Thanks. Molly McNeil, are there any places? Okay, got that. Jimmy Jones. Could you look at SWBI again? Smith & Wesson. I mean, I gotta be honest with you. If you look at history, the best time to buy these gun companies is when a Democrat gets elected because everyone fears that their guns are going to get taken away. If you look at the Obama administration, the thing went up 20x or whatever it was, less than 20x. It was like whatever, 15x. Then under Biden, again 10x. So no one's worried that Trump's going to take away their guns, so they're not rushing to the stores. Negative free cash. They're probably going to recover. They haven't recovered yet. I'm still not interested, Jimmy. But it could work as a trade. Saber Corp. Oh yeah, this is the software. I had some guys pitch me on the private version of this, and they spent an hour on the phone telling me why Saber was going bankrupt or going out of business. I kind of liked it when they were pitching me on investing in their private deal. It does look like they're recovering, but this is a low quality business, and if 10% of what they said is true, I'm not that interested, but they did get me interested more in investing in Sabre than they did in investing in their thing. So I think they do like software for airline stuff. Let me just see. Yeah, for the travel industry. Let's just take a look and see if anything's changed. Yeah, I mean, this is digging in the trash bin. Let me just double check here. APR. Financials. Yeah, it looks like their revenues are recovering a little bit with the industry. Free cash flow is probably going to turn positive. Let's see what their balance sheet looks like. Good amount of cash. And, $5 billion of debt. That's not ideal. And then let's see what they've done. Yeah, they've just diluted the hell out of their shareholders. I don't like these type of people. I mean, anyone that destroys their shareholders like that, I'm not interested in. Okay, new CEO, but that's April of 2023. Margins seem to be improving. A lot of insider buying. All right, maybe. I mean, I like your thinking. For me, I don't need to. I like to sleep well at night. That's not a way to do it. We got that. Shad River. Thoughts on Petrobras? We covered this a million times. Not for me. 21% dividend. All you need is that socialist to wake up and cut the dividend. I mean, no way. Jason Zen. Sebastian P. National retail properties. Nah. That's not for me. And no, there are not other REITs I really want to look at other than Crown Castle right now. I mean, it's probably okay, but it's pulled back like 2 cents. So now you're excited with the 10% pullback. There's no asymmetry there. I'm not interested. I don't buy things for dividends. Kraft Heinz. I think it's okay. I think a bunch of these like Pepsi and Hershey, and they're going to do probably a bit better this year. I wouldn't be a buyer of Pepsi, but yeah, these things haven't come in enough. So that one's probably okay. I took a brief look at it this week again. What are your thoughts about macroeconomic challenges of Brazil, also Latin America as a whole? I'm not ready to do anything in either of those markets. The asymmetry is better in China because the worst case is already in China, whereas those places it could get worse before it gets better. But I think all emerging markets are going to work. I just don't have any pound-the-table companies that are priced with the asymmetry. I need to take the risk of $1 and get many dollars back, and I'm just not finding them to the level of comfort that I want. There are beat up things I could buy, but I don't have comfort. You know, it's taking country risk, geopolitical risk, company risk, all of that stuff. So you have to buy the highest quality, and I'm not finding the highest quality at levels that I want them. So for now, it's a pass, but I'm finding it all day long with Alibaba. So that's where it is for today. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.